Hey, folks, good morning. Uh, Thanks for tuning into our MMG weekly recap. On a Friday, we're watching the 10-year note dip into the 130s. An amazing and sharp move higher in prices in both mortgage-backed securities and the Treasury market, and providing another just an incredible opportunity for your partners and your clients. And this move lower is fueled by a few things. Number one was the Fed this week, right? They tapered bond purchases, right? Meaning they're buying less, and they're going to wrap that pandemic-induced bond buying by the middle of March. The second thing is they forecasted as many as 6 rate hikes over the next 2 years. And people say, wow, if the Fed is going to hike rates that many times, how come 10-year note yield is moving lower? Well, two things. Number one, uh, if the Fed were to do that, and that remains to be seen, candidly at MMG, we don't think they're going to hike 6 times. Something really good has to happen really quick. And we're actually watching the economy kind of turn over, and things are slowing down. That together with rate hikes, I think is what you're seeing the 10-year note yield reflect, is that there's going to be even a slower economy, which by definition would tamp down some inflation and some demand. So that's what the bond market is looking at right now. It is certainly not worried about runaway inflation with a 138 handle on the 10-year note. So the rate hikes are out there. We'll be data driven to see if we get there. We don't think it's going to happen, but the bond market is certainly looking at that piece. The other thing the bond market is looking at is Omicron, and it's exploding in the Northeast. It's creating a lot of uncertainty. I think that Omicron, it's not looking necessarily at the human toll, the markets. It's looking at the economic toll, and we're already starting to see some heavy shutdowns, travel restrictions, mandates all over the place, and of which none of which help economic activity. So the bond market is pricing in this uncertainty, pricing with the Fed policy as well as Omicron, and the likely slowdown of certain activity and economic disruption caused by, again, this new variant exploding. So that's what we're dealing with going into this weekend. And looking ahead, next week we have the Fed's favorite gauge of inflation in a short trading week, right? We have Christmas. And so the bond markets close at 2 o'clock next Thursday and close entirely next Friday. So you have this short week in which a lot of traders are going to be out. It could be very, very volatile. So I encourage you to stay very nimble with your pipeline, especially those that are going to close in the short term, because sometimes these short term, these pops that are created by fear can be quickly removed. So I hope this finds you well. Have a wonderful weekend, and we'll be back at it next week. Bye for now.